Wednesday.
That's right. Oil. So we have some volatility across the board, definitely in the oil market as well. We'll jump over to the NADEX platform. So we're looking at the crude contract. We're in the July contract now.
Yeah.
Crude currently trading above $72. Prices at the pump definitely going up, man.
Oh, yeah.
72.05. So let's look at setting up a volatility trade. It's 10:20 right now. We get the EIA inventory number at 10:30, 10 minutes from right now. And so I jumped in here originally. I took a look at the spreads that expire at 11 a.m. Those are going to give us an option with maybe 71.75 we could use. Now we're trading at 72.05, so that's 30 cents away, or 72.50 if we're looking to make a volatility trade, right? When we go over this Wednesdays, Thursdays, maybe natural gas. We're going to be looking to purchase a spread with bullish potential, sell the spread with bearish potential, and ideally when you're just looking for volatility, they line up right where the spreads begin. So we don't have a good scenario for 11 a.m. exactly, but what's nice is I jumped around ahead of this segment. The noons and the 2:30s do, so we'll go through each one of them, right? Yeah. So they line up at 72, which is nice. So we'll start with the ones that expire at 12, and we're going to start, and we'll pull up the bullish spread, which has exposure from 72 to 73.50. Yeah. We're going to look at the bearish spread, which has the same $1.50 exposure, just to the downside, 72 to $70.50. So if you're looking to place a volatility trade, you have exposure in both directions. You'd be buying the bullish spread, you'd be selling the bearish spread, and what's going to happen here is that you have 5 pennies, call it, of intrinsic value. 6 pennies now of intrinsic value to the bullish side. Yes. So your bullish spread is going to be about $6 more than the bearish spread, and this is where they line up. Your bullish spread's 27, your bearish spread's 22, so you're looking at about $49, which would be 49 cents, right, away from 72. We'll just call it 50 cents for easy math. Yeah. So you need 50 cents a movement by noon to break even away from 72, right? And you got about a 4 or 5 penny head start to the upside. Okay. So that's your 12, right? So what's nice here is immediately they have the spreads that start at 8 a.m. or they have the dailies that start really last night. Yes. That are a little bit bigger. So we'll jump to the 8 till 2:30s. Now these are $3 spreads. Okay. So they go from 72 to 75. And what I'm going to show is, I'll pull up this bid real quick. So this is your bullish spread. But what usually happens, right, is when they have identical price points for the 230, what I want to point out is, so this is the one that has $5. And look at the bid offer spread here, okay? Here's your one that has $3 of potential. Here's the one that has $5 of potential. And they're identical bid offers, okay? So we see it a lot. So you don't have to pay for the extra $2. $2, right? You know, if you're purchasing this, they're not, it's a similar time, as in exactly, you have till 2:30, and so the market's not making you pay for that extra $2 of potential if you somehow got a spike above $75 in oil, which guess what, man, oil's been rocking, right? You never know in terms of, there's geopolitical risk going on over there, something could happen in the news, who knows, right? And so, 2:30 is a long time. It is a long time. It's it's 4 hours in a trading day. We've already seen some volatility, whether it's in the dollar, right, in gold. So it's in play for sure. So I'm just going to close those out. If you're going to make this trade, no matter whether you were going just bullish, just bearish, right? I mean, if you're just making a bullish trade, same thing. You would want to be purchasing this one, right? Because you want that exposure if you don't have to pay for it. So this would be our bullish spread, and again, we have 72 to 77. All right, that's costing you $33. Which isn't really bad as we go through these, because what was the other one costing us? Not much. 49 total. Yeah, right. The 22 was on that side. 24 maybe. So that would be our bullish spread, 72 to 77. Yeah. Here would be your bearish spread, again, $5 to the downside. So look how intriguing this is. We're talking about $61 versus 49. My opinion would be that is a premium worth paying for. Right. When you're only talking about $13, $14 extra, which represents only 14 cents in oil that you need, and you have the 2.5 extra hours, and if you ever get a moonshot, the big numbers, you have the $5. Because $1.50 is definitely in play. All right. Right. And so yeah, not bad setups. And again, the price to remember is that these all start at 72 as our pivot point, I like to call it. Right. So anything away from 72, you're gaining value on. 72 being your max loss if you're making this trade. But what's nice here as well is these aren't bad if you just want to go directional. We always like looking at it because you don't need a directional bias, you just need a volatility bias.
Yes.
But if you're bullish, if you're bearish, you can always just go in and purchase one side, and it's really not bad in terms of, you're paying only 30 cents, about 28, 30 cents on either side.
For a long period of time.
For 4 hours with EIA about to break.
And, last night when the API came out, we didn't really get a lot of movement inside it. And there was I think it was a drawdown of only like 987,000 barrels or something.
Okay.
But
and I'm zooming over to the chart right there. You can see it. Not too much volatility at all. Came out 4:30 last night, and we were trading at about 72 before that. And it spikes like we spiked up about 13 pennies on that news, and it's pretty intriguing that we're literally like at the exact price before that API number. So
it doesn't seem like this oil market just doesn't want to back off.
No, it does not.
It just doesn't want to back off.
Headlines for $5 oil in New York, I was telling you yesterday. And
for gasoline,
for gas. And we're a far cry. That's probably, who knows where that is in New York. It's buried somewhere where it must be tough to get to, or just so busy, one of these areas in New York. But still, we haven't seen $5 oil anywhere in the country in a while. So here's what's intriguing. We're at 72 on the dot right now, right?
Yep.
So let's see how these recalibrate with literally indicative index at 72, all right? So it's nice. Here's your bullish, here's your bearish. So now we're talking about 58. See how it pulls out that intrinsic value?
Yeah.
So it's nice when they line up right at 72.
That's amazing.
It is.
Stay right there, folks. Tommy and I are going to be coming right back with those numbers for you. Our phone number is 877-927-6648. We're going to be right back with those oil numbers, folks. Welcome back, folks. We got some quick movement in this oil market.
We got a good one today. It's always nice when we see some action. So we were trading just above 72, right at 72. Talk about a 50-cent move in a heartbeat. And what's it coming from? So we had a build of 5.78 million barrels in crude.
Monster.
It's especially surprising given the fact that the median analyst estimate was a decline of about 2 million barrels. The Bloomberg user survey was a decline of about 1 million barrels. So call it what you want. They were looking for a decline of between 1 to 2 million barrels. You get a build.
And look at the build in gasoline, too.
6 million barrels in crude. Gasoline inventories rising 1.88 million barrels. That is going to send the price downwards when you have much more, and check out that action. So the trades we were looking at had 72 as that pivot point. Anything away from 72, you start gaining value in, right? You had your noon trades costing us about $48 total. So already right away you're approaching break even for those trades. If you wanted to take one side off, you could take the bearish side off if you wanted to, and even just to jump to it. So here was our noon trades. This would be your bearish spread. That's where all the value is going to be right now. You could buy that back for about 45. You're looking for 48 if you expected this to kind of pop back up to the 72. But I don't know, on those types of numbers, right?
That 230 one, this gets really intriguing, folks, because the 230, the one we were going through, the Tommy was going through, is a $5 spread. And you have till 2:30 this afternoon. Now, you can get $1.50, like, pretty quickly, because this market is getting, that's a lot of oil, man.
It is a lot of oil. When you look at the fact that they were looking for 2 million to the downside, you had 6 million to the upside. That's an $8 million miss from the estimates that, they didn't, 3 minutes ago, they thought, the whole world thought there was going to be 8 million less barrels of crude than there are. And so now there's 8 million extra barrels, so that reprices supply and demand. They're just that simple. So the noon trades, you had $1.50 of exposure. And so really your profits are capped out at $70.50 to the downside. That would be $150 in value. Putting up about a 48, that's your max profit if you just close out the bear, as in not even close out, if you're just gaining value from one side of that trade, all bearish at this point, obviously. And then the 230s, you do have that extra exposure, which on a day like today, you may get more than $1.50.
That's a mean move, man.
It is. And even, and this is why we always illustrate in terms of, we pulled up the original 230s that have the $3 of action, right? On a number like that, by 230, we could see more than $3 of action. So it just illustrates exactly why you want to get familiar. And you weren't going to have to pay for that extra. It would have been a shame if you just ever weren't aware, right? You just went in, you made the trade, and you decided to make the $3 one, not being aware that there's an identical spread just with extra exposure you don't even have to pay for. And on a day like today, look at it running. So right now, again, this would have been our bearish spread. Now we're looking at the $5 one, and you can see already we got $77 of value in there as oil's down $73 basically, from 73 cents from where we were.
Both sides only cost us 61.
Right, for this trade, both sides of it, we're going to cost you about 61. Even as it recalibrated back to right at 72, it came in. It was about 58, 59.
Right.
And man, oil, that's quite a move. We haven't seen a move of 75 cents in the span of 3 minutes, right? But we haven't seen an 8 million barrel miss.
Right.
I can't remember one, really.
Right.
So we'll check back in, but always fun when we get some action. Maybe we'll be paying cheaper prices after all.
Thank God.
We'll see. Okay.
Yeah, let's. I actually want to.
Oh, look! Before we just jump around, here's the the full wrap up of the numbers. So there's your
look. Oh, look at that thing! Oh my God! Look at these. Watch these numbers, folks.
Yeah, numbers across the board from misses. I mean, there's your big top headline number, right? Crude with the almost 6 million barrel build. Estimate was 2 million.
No, the estimate was 2 million negative.
Yes,
and
right.
With a 5.7 build.
Yes.
Right.
And Cushing crude, you saw a decline of about 1.2. PAD 3 crude, increase of 3.1. I'm wondering what the expectation was there. That seems to be a big build for PAD 3. Gasoline, again, just like decline was it was an estimate for a decline of 1.4. I mean, all these numbers, look how quick they're loading on a day like today. And then you had a build in gas, same thing, 1.8. Distillate's pretty close to estimates in there.
Yeah.
Let's see, fuel demand. So demand rising 2% in the past 4 weeks. Be interesting to see how that plays out.
So
in terms of how
even
that
with
factors
demand
in.
rising, we still have more gas. Yeah.
Yeah.
And that's a justification that if we owned an oil mill, oil, you'd want to push out as much as you could out at $70 a barrel.
Probably,
right?
yeah. Probably even 72, right? I mean, it's not even 70, which is remarkable. All right, before we jump away, because it's moving so quick, all right, 71.30, and we'll check back in.
I love
Pretty
it, man.
cool. Let's check back in on oil one more time. So it's approaching 11 o'clock. We're about 25 minutes after those numbers, and just kind of hanging down there. We hit a low of about 71.20, so we're 19 pennies off that low. But we're hanging low, and no matter what trade you had made, we're now 60+ cents below 72. So you're in a profitable position if you're making that volatility trade.
Yes.
And again, if you were bullish or bearish, if you're bullish, well, you're straight out of luck, obviously.
Right.
But if you were bearish, that one was only going to cost you about $30. So that's where you can see if you do pick the right side. I personally like the volatility trades because you don't need to pick a direction.
Right.
And as we've seen recently, man, we have some volatility in this oil market, and that's not a lot of premium. Again, everything's personal preference, bias, but not a lot of premium, and it's kind of shown to fruition when you see the type of moves that can come, man, in the span of... I was going to say a minute, in the span of like 8 seconds after those numbers come out.
Right.
So, interesting trade, interesting action. Maybe we'll see some lower prices at the gas pump coming soon. We'll see, hopefully.
Yeah.
All right.